You know, investing can feel super confusing, right? You hear all these different terms, but what's the actual path from something safe to something risky? Well, in this explainer, we're going to lay out that map by thinking about the world of investing as a simple ladder. So, let's get climbing.
Everywhere you turn, someone's throwing these words at you. Stocks, bonds, CDs. It's just this alphabet soup of finance. But what on earth do they all mean? And more importantly, how do they all fit together in a way that actually makes sense?
Okay, let's break it all down. I want you to picture this, an investment ladder. Every single rung we climb up is going to represent a different level of risk and a different potential for reward. We're going to start at the very bottom, on the ground floor, where things are as safe as they can be. Ready?
First things first, every climb starts on solid ground. On our ladder, this is the ground floor. Think of this as your financial home base. These are the kinds of investments that are designed to be really, really safe and easy to get to.
So, right at the bottom, you've got something called non-marketable assets. I know, it's a mouthful, but all it really means is that you can't just turn around and sell it to someone else. It's a deal just between you and an institution like your bank. And the huge plus here, they're usually very liquid, which means you can get your cash out fast if you need it.
And hey, look at this. You already know these. Savings accounts, CDs, money market accounts. You've probably heard of these your whole life. This is the foundation, right? Super simple, super safe. You know exactly what you're getting into.
All right, let's take just one tiny step up. We're still pretty much on the ground floor, but we're moving into what are called money market securities. These are still super short-term and very low risk, but there's one key change. That word, marketable. Unlike your savings account, you can actually buy and sell these.
So what does that even look like? Well, we're talking about things like T-bills, which is basically you giving a super short-term loan to the US government. Or commercial paper, which is like a short-term loan to a huge company. See? Still very, very safe, just a little different from your basic savings account.
Okay, time to start climbing for real. We're moving up to the next big rung on our ladder, and this is the world of bonds. You know, the simplest way to think about a bond is this. You get to be the bank. You're lending your money out to a government or a big corporation, and in return, they promise to pay you back.
And it works just like this. 1. You lend out your money. 2. They pay you interest on a regular schedule. It's a fixed payment. You know exactly what's coming. And 3, when the time's up, what they call maturity, you get all your original money back. Boom! You were the lender.
Okay, this right here is maybe the most important difference to get. It's all about being a lender versus being an owner. With a bond, you're the lender. You get paid your fixed income pretty much no matter what. And if the company hits the skids, you're one of the first people online to get paid back. But with a stock, you're an owner. And owners, well, they get what's left over at the very end.
Now that doesn't mean being a lender is totally risk-free, right? There's always a catch. With bonds, the big boogeyman is called default risk. And that's just a fancy way of asking, what if they can't pay me back? So how do you even know what the risk is?
Well, luckily, you don't have to figure it out all by yourself. Companies like S&P are like financial detectives. They do all the research and give each bond a grade. Literally, like a report card in school. Investment grade is like getting an A or a B. It's considered pretty solid. Speculative grade is more like a C or a D. You're taking a much bigger chance that you might not get paid back.
All right, we've talked all about being the lender. You ready to climb higher? Because now we're going to stop being the lender and start being the owner. Let's get into the world of stocks.
This is a whole different ballgame. When you buy a stock, you're not lending money anymore. You're buying a tiny slice of the actual company. You're an owner, and that means you're in it for the ride. If the company does great, you can do great. But if it doesn't, well, that's where the risk really starts to kick in.
So what are the perks of being an owner? Well, for one, you get a piece of the profits. You often get to vote on how the company is run, and hey, the most you can ever lose is what you put in. But, and this is a big but, remember what we said? You're the residual claimant. That's a technical term for the person who gets the scraps. If the company fails, everyone else, the bondholders, the lenders, they all get paid before you do.
And just to make things interesting, there are actually two main flavors of stock, common and preferred. Think of preferred stock as this weird hybrid. It's kind of like a stock, but it acts a little like a bond because it pays you a fixed amount, called the dividend. And the name says it all. They get preferred treatment. They're paid before the common stockholders. Common stock, on the other hand, is the real deal. It's pure ownership, with all the potential upside and all the final risk.
Okay, take a breath. We've climbed from the safe ground floor
up through the world of lending with bonds, and into the world of ownership with stocks. Now we're going to the very, very top of the ladder. This is where things get really advanced.
Welcome to the top-rung derivatives. Now, these are not for the faint of heart. They are seriously complex tools, and with that complexity comes a whole lot of risk. This is really the playground for professional and very experienced investors.
The key thing to understand is right there in the name, derive. A derivative's value is completely derived from something else. It doesn't have value on its own. Its price is tied to the price of another asset. Could be a stock, a bond, a barrel of oil, anything.
The two you'll hear about most are options and futures. Here's the difference in a nutshell. An option gives you the right to do something, but you don't have to. A future is a contract that says you must do it. And it's funny, because they were actually invented to reduce risk for businesses to protect themselves from prices changing unexpectedly.
And there you have it, the entire investment ladder. We went from the solid ground of a savings account all the way up to the high-wire act of derivatives. Every single rung has its place, its own level of risk, and its own potential reward. Now that you can see the whole picture, you can start to figure out, hey, where am I on this ladder, and where do I want to go? So the real question is, where does your climb begin?